Today we're going to go over a lot of slides around the economy, so I apologize ahead of time. It's going to be a lot of charts and a lot of data, but hopefully you can glean a few things from that and also have this as a resource, as you're moving forward as well. So we'll have plenty of time at the end of this too to have questions and really kind of talk over some things. Some of the material is information I've covered in past webinars, so if you've attended some of those, you may see some of that repeated, but I've also put some new stuff in there as well. So let's go ahead and get started. We're going to talk about Missouri's economy. And when you start with any kind of talk about the economy, you start at the point of gross domestic product. Gross domestic product is that largest number of all output that we have for our state that is really the market value of goods and services that we produce in the economy. So it is that final sale of something and then tracking that number. It's not a perfect measure, but it's what we use for the U.S., for countries, for the state, for metros, and recently we even got county level gross domestic product from the Bureau of Economic Analysis. So the chart on the right there you'll see is really the gross domestic product for 2019, which was over $300 billion for Missouri, compared to the U.S. in terms of the percentage of gross domestic product by industry. And so I think that's helpful because a lot of times we do mirror what the U.S. does in terms of the economy, in terms of job growth, in terms of general things. And so knowing where we're like the U.S. is kind of interesting, and then also where we're a little different. So just like the U.S., our top three gross domestic product industries are finance, insurance, real estate, kind of grouped up into one, and we call that the acronym FIRE for that group. Professional and business services is everything from your headquarters companies to your attorneys, your accounting firms, your IT firms, and so forth. Manufacturing is the third on that. And you can see as you go down the line there, the different industries, you can see where we're like the US in a lot of those areas. For example, with, let's just take retail trade, we're just about exactly on average as the US. Transportation and warehousing, go all the way down to the bottom. Mining, we're not as concentrated in that, but agriculture, we're just at the US average with that as well, arts and rec, and on the way up. Where we're different is that we are a little bit more strong in professional and business services, in manufacturing, wholesale trade, and healthcare and social assistance. So we're just a little bit stronger in GDP or concentrated in GDP than the US average there. Now, one of the things that that's been happening at the city level here in Missouri, in the Midwest, in the US, and in developed countries over the last decade and even more, is the accelerated growth of jobs in urban areas. And so that certainly happened here in Missouri and in other places. And to illustrate that, this is a chart from 2013 to 2018 that's in the Missouri Economic Research Report, the annual report that Merrick puts out. And you can see Missouri is the big gray circle there in the middle, and it grew over that time period, that 5 years, at just over 1%, like 1.1, 1.2%. But we see Kansas City in the Ozark region, Ozark being where Springfield's at, growing at 2%, St. Louis a little bit above average, and then the other 7 regions that Merrick uses growing at below that average rate, and even South Central losing. So this trend is just helpful to understand where those jobs are growing, what's happening at a larger scale. That trend's probably going to continue. Right now, we know that last year when we had a shortage of workers, one of the top concerns for companies expanding or locating was that availability of labor, that availability of skilled labor and skill in many different forms. And so that trend's not going to stop. It's going to only continue. And so knowledge is the new money moving forward, and knowing that, that cities are gaining that share is just something to be aware of. Now, when we look at 2014 to 2019, so looking at the job changes over those 5 years, I pulled together some information to kind of contrast a little bit about what's happening in the really urban areas of Missouri versus the non-urban areas, rural counties. Now here I've defined rural a little bit differently than we commonly do. Commonly we define rural by those counties that are non-metro. So when you take Springfield, for example, Greene County is going to be that core metro, Christian County down there, but there's also other counties involved with that metropolitan area. I went ahead and just did some analysis, pulling out only the core metro counties just to try to contrast that versus the non-metro counties and the counties that aren't part of that core in a metro. So we can kind of just pull out a little bit more detail about how their different trends have happened over the last 5 years. So overall, the 5-year employment change in those rural counties was 3%. Core metro is 6%. So double that growth. And again, that goes back to that mega trend and that we're seeing in Missouri and of course across the US. When we look at what's grown over the past 5 years and what's declined in terms of percentage, we look at sectors such as professional, scientific, and tech services in the rural counties, 17%. So think about that. The whole rural area grew at 3%, yet professional, scientific, and tech services grew at 17%, so much faster. Healthcare, social assistance grew much faster. Transportation and warehousing, much faster. Now, on the flip side, the industries that declined were in a large number, and I did select for at least 1,000 employment. So we have some very small industries such as mining and stuff that can grow at high percentages, but they may be small numbers. But we saw government jobs go down, finance and insurance, that's your banking industry, and then wholesale trade. So we've seen that those pretty substantial declines in that area, offset obviously by some of these other places or industries that grew. Manufacturing was one that also grew in the rural communities. When we look at the core metro counties, we see, again, professional, scientific, and tech services. So 20% growth, so even faster in these core metro areas over that past 5 years. Again, a same trend though, both the top growing one in rural and core metro counties. So a lot of times we think of these places as being very significantly different, and sometimes they're not. Sometimes they actually have some very similar trends. Construction also grew quickly. Now construction went down substantially with the recession and had to come out of a pretty big hole of job decline. And so its growth is trying to get back up to normal and above that a little bit. Transportation and warehousing, just like in the rural counties, also grew pretty substantially. So more of that distribution center growth, we've seen that here, and I know in central Missouri and in other places. So that has continued to be a job growth engine there for Missouri. And again, just like in the rural counties, government numbers went down, arts, entertainment, and recreation, and then finally information. And just a little bit about information, it's not software companies. When we see information, a lot of times we think mainly software companies. Think more of the AT&Ts of the world, the hard line, wired communication type of firms and so forth. So that has seen declines as well. Now, we can't talk about the economy without talking about COVID-19, obviously, and what's happening there. You know, we know that right now we're going to see some of the worst of the layoffs. We're seeing some of the worst of the impacts from our social distancing. So it's not unexpected, but we do want to kind of track how that's happening here in Missouri. We don't know how long it's going to last. Will this drop be a quarter? Will it be 2 quarters that are significantly declining for us? You know, if this is a few months of social distancing and we're starting to open up, states are starting to do that now. In the summer, we get back to quasi-normal behavior, then those businesses and hopefully workers will rebound. As you get past that, 6 months seems to be kind of a general period of worry, because after that time, it's been shown that worker skills really deteriorate after 6 months. It gets harder and harder to get those jobs back. So we're hoping, obviously, that this won't last that long. However, we have the possibility of the fall and winter with the COVID-19 coming back, and then having to institute some social distancing again, or just to continue that. So obviously those things will have major impacts on our economy, and we're still waiting to see what that will be. Now, on the positive side, there is money that's been coming to help, obviously, the unemployed, to help small businesses. We had that $2.2 trillion package. We know last week that the PPP ran out of $350 billion, was already out the door. We know that there's additional money. I think today they're voting on the remainder of that $484 billion additional funds to go out, $310 billion of that being the PPP, and then some for hospitals as well. Also, largely impactful with this $2.2 trillion is the unemployment benefits, that $600 more that the federal government's putting into that unemployment check, which will help people around the state. So those are things that are counteracting and will counteract some of these layoffs, not right now because we're just not spending that money, but that will keep people paying rent, that will keep people being able to pay utilities and so forth. So maybe just getting by for some people, obviously not enough to save all the companies that are out there, but let's hope that that has a good counteracting effect. In March, we had the state numbers come out. They came out just last week for March, so it's a month delay there, but we saw a 21,000 job decline in March. Now, unfortunately, that's not the worst month. Next month, when the April numbers come out, we expect to see a much bigger number, but this is certainly a big number for us. Typically, in a average month during a growth period, we're adding 1,000 to 2,000 jobs a month. So to have 21,000 drop in 1 month is pretty substantial. Over half of that was in accommodations and food services, so your hotels and restaurants. Construction took a big hit, and of course, this is when construction is usually taking off here in the spring. And then equally, manufacturing, healthcare, and professional services were all down 2,000, around 2,000 jobs. So pretty substantial. Our unemployment rate went up to 4.5%, a little bit higher than the US. And we don't have current quarterly domestic product numbers, but we do have the numbers as of 2019 fourth quarter. And at that time, we were just under 300 billion. We were growing at 1.8% on the annualized rate, just below the US. And that trend has been kind of common throughout this last 5 to 6 years. We've been growing a little bit less than the US average. However, I think last year we were actually a little bit above. We had taken off a little bit, and some of that due to transportation equipment manufacturing. But now, obviously, when we get these numbers for 2020, we'll expect to see declines in the second quarter of this year and maybe the third quarter. So initial unemployment claims comes out every Thursday. So this morning at 7:30 our time, we had the U.S. Initial unemployment claims come out, and then they also have the state level information as well with that. So looking at the past 5 weeks in the state of Missouri, totals up to just under 400,000 in claims in a 5-week period. So very substantial, given that our labor force is 3.1 million. So a large percentage of our workforce is filing for unemployment. Now, economists nationwide poll of what the nationwide rate could be in terms of unemployment. Economists are looking at least 13%, maybe more. The reason why we don't know exactly is obviously there's not an exact number we can pin now, but we do know that more people qualify for unemployment insurance now. However, we know that some people aren't looking for employment, because if you're laid off and you're laid off temporarily, or you're laid off and you don't really expect to find another job, you're not going to be counted in the labor force. So that rate is definitely going to jump. We just don't know how high yet. Now, the layoffs that were noted from Missouri were in accommodations and food services. Again, not unexpected. Retail, arts, and entertainment. So that's your tourism-related activities there. Then also we see manufacturing, transportation, warehousing, and admin support, also very much related to each other. A lot of times when manufacturing goes down, so does transportation. And admin support, a lot of those admin support jobs are in the manufacturing temp contract work type of activities. So you'll see admin support usually going down in concert with manufacturing. And then of course we had healthcare, and healthcare being the services that we have for just our regular care that we usually go to, our doctor's visits and dentist visits and so forth, and that's not happening. So those are temporary layoffs there. Now, when we look at tourism a little bit, I did some numbers just to kind of, again, look at that rural and core metro number a little bit more and to understand how different we are in these different areas. Tourism-related jobs, select retail jobs were some of the first impacted, obviously, by this coronavirus. And we see that these jobs in total represent over 400,000 jobs in our economy, so 18% of our private sector workforce. And they're about evenly spread between the core metro and the rural areas, about 18% in core metro and 17% in rural. So this is something that's hitting both the urban and the rural areas. In the urban areas, some of the biggest employers are the casinos that have had temporary layoffs. If you look at our state notices of layoffs, you'll see a lot of casinos there. And so those have a lot of numbers in one spot. And then just across the board, we're seeing declines in these areas. Now, I select retail stores that are not grocery stores, that are not super centers, pharmacy, hardware stores, and stuff like those, because those places are actually hanging on pretty well right now with increases in sales there. When we look at tourism, it won't be a surprise to many of you, but I think having employment concentration maps are very good ways to kind of look at where things are concentrated in the state by the county. So when we look at tourism related and select retail businesses, we see the darker spots there being the higher concentration. And just for reference, for those of you who aren't familiar with how the concentration numbers work, it's called location quotient. And a location quotient of 2, for example, means that that industry is twice as concentrated in that area as would be expected for the national average. So when you see 3, it's 3 times concentration. Or if you see 1, that means we're exactly as concentrated in that industry. So we'll see a few maps coming up that talk about location quotient and employment concentration. And here we see around the Lake of the Ozarks, around Branson, we have those concentrations of tourism related activities. Now, of course, another big sector is manufacturing, and even larger is healthcare and social assistance. So I took a look at those and sliced the numbers by those 2 different areas just to see how those areas differ. Manufacturing is about 276,000 jobs, 250,000 jobs, 12% of our private sector employment. It's more concentrated in the rural counties, 17% of private sector employment versus 10% in the metro area, the core metro areas. And then you have healthcare and social assistance, which is 17% and a little bit more evenly divided between core metro at 18% and rural at 16%. So healthcare, tourism related jobs were fairly similar between the core metro and the rural areas, but manufacturing is more tilted in terms of concentration in the rural counties. You'll look at the jobs associated with that. There's more jobs actually in manufacturing in the core metro areas, but in relative to private sector employment, it's stronger in the rural areas. And again, concentration maps for manufacturing. We see concentrations east of St. Louis and the counties around between Jeff City and St. Louis. Some of that's related to building materials, transportation equipment. We see counties up in the northern part of Missouri, some of that related to food manufacturing, and then around Lebanon with boat manufacturing and other things there. And then down in the southwest of Missouri, we see that some concentrations there in manufacturing, and a lot of that to do with food services as well. So if you look at where we're concentrated in different sectors of manufacturing, we are concentrated in transportation equipment, be it Boeing or the F-150s we make, or the GM vans and trucks, to boats. So we are concentrated in that sector. We're concentrated in food processing and meat processing in particular, animal food products. So we have some of those concentrations. Electrical equipment is also one of the ones that we concentrate in. And then if you look at healthcare on the right there, we have healthcare concentrated broadly around the state in different counties, but what you'll see is it really focused in the southeast there. In terms of relative employment, it's pretty concentrated in those areas. Those areas are also areas where there's usually higher unemployment rates, higher poverty rates, a little bit more depressed economies, and so having a healthcare impact there is definitely not good for that economy. I did want to turn a little bit to meat processing. It's been in the news in the last week. We've had Smithfield, Conagra, Burger Smokehouse announcing temporary closures as they're trying to sanitize the places and look at practices to help avoid the spread of COVID-19. It's a tight environment. People are working close together, and so those are where the outbreaks have happened a lot. I know Iowa's seen a lot of closings. Hopefully they're temporary. We can see it at the, looking again at the maps here, that meat processing employment, just employment numbers are concentrated in places like St. Joe and in the Southwest and in different places around the state. If we turn that to the relative concentration of meat processing, we see Saline County, I'm sorry, I said Saline, I meant Sullivan County up there, really bright because there's a really big food processing plant up there. And then we see in the Southwest as well. So a little bit more concentrated in certain areas. One of the other things that we try to do is look at current indicators that are out there. And it's hard, honestly, it's hard to find a lot of good data out there that's really current, because it's just, it relies a lot on private sector information. One of the ones we've stumbled across is a site called womply.com that does track credit card transactions by county, by different industries. They don't allow you to download all the data because that's their business model. They want to sell that information, but they do allow you to pull out stuff with some work. And so we gathered a little bit of detail for the week ending April 11th and April 4th is in gray behind that just for comparison. But these are the changes in revenue, percent changes in revenue compared to the same week the year prior, so in 2019. And you can see retail and wholesale is actually up. Food and beverage shops, that's going to be your grocery stores, are up. Sports and rec places, your golf centers and so forth, is up. So you see some places actually up in terms of those transactions. And then of course at the other end, transportation services, health and beauty stores, lodging, hotels and restaurants down substantially. So, that's one thing that we can track in terms of what's happening in terms of sales. They also provide some maps on a select few number of industries. So for example, restaurants, average revenue changed from the April 11th week compared to last year. You see it mostly in red for most counties where there's data available. They also estimate that over 6 in 10 restaurants are open. So they're open, but they're doing the curbside and delivery type of activities. On the retail side, we see 7 in 10 retail stores, according to their numbers, were open, and more mixed. We see some green in a lot of counties where a lot of that's going to be due to that Walmart, that grocery store impacts that are where the sales are happening, and pharmacies and so forth. The FAPRI group did some farm income estimates for 2020. I was able to sit in on part of that webinar. I think it was last week, really excellent webinar. And I think it's on the YouTube channel for Engaging for Missouri if you want to catch that. But they had done some preliminary analysis, and they did definitely couch it as very preliminary, but looking at possible declines in farm income this year at around 19%. We know that obviously there's a lot of counties that are dependent on farming. And if we look at the map of the US map from the USDA on farming dependent counties, we see a lot there in northern Missouri that 25% or more of their labor income comes from farming, or at least 16% of their jobs. So we see that obviously throughout a lot of the Midwest states there, Iowa, Nebraska, and Kansas and so forth. So a concern for us. The last couple of weeks, we've seen some surveys from different industries. This one I thought was very interesting, and there was also a webinar on this as well, so you may have heard this, and I apologize if you have. But I thought it was really interesting. Survey of over 5,800 companies, businesses, and commercial districts the weeks of March 25th through April 6th. 91% of these were small firms, under 20 people. Most of them in food service, non-food retail, and then a lot in the other category. That's that chart to the left. So you can kind of see the distribution of those type of companies. And also you can see kind of, which I thought was telling, how long could you go before risking permanent closure. So we see that a third of companies, 3 to 5 months is all they can do, before they're going to be permanently closed. So, again, we have that short term where we hope that this won't cause the permanent closure of companies, but as we can see, there's definitely worry if we're dragging on 3 to 5 months for closures. And this was a very interesting piece of information for me as well. when they asked what assistance would be most helpful, you of course see 70 and 65% around financial assistance, around extending, giving breaks for rent and utilities until they have money coming in. So that's very logical. Protecting workers and customers, the next highest one, obviously wanting assistance with that. But then I thought the three, around 16% of firms saying, modifying their business plan, social media training, website development, and e-commerce were some of the things that they were looking at. And of course, you see that as a lot of businesses now are thinking about their online presence, how they can boost that. Because once we come out of this this time period, we're going to be a more online savvy consumer group. We're going to have businesses that are online, taking advantage of those opportunities. And so I think businesses are rightly concerned with trying to boost their presence online. All right, just lastly, I wanted to mention that we do have, every couple of weeks, we're putting out a 2-page brief about different indicators, which you can get to on the CED site. And so we've done 3, and our last one just came out with some of the Womply data and a map about meat processing, which you've seen. But anyways, we'll keep updating that with topical information. So I hope that's of use to you. And that's it. Let's maybe open the floor to discussion and any questions you have.
Awesome. Great. Thank you, Alan. That was great. So again, if you have a question, feel free to unmute yourself and ask it, or I have the chat open.
Hey, Alan.
Yeah.
Alan, this is Elizabeth
Yes.
Smith. Hey, so I have a question for you, and this is something, again, sort of anecdotally I see, and I don't know if there's anything to bear this out, but is there a trend, or is there any evidence of a trend of businesses like large service or manufacturing moving to or creating a presence in more rural, less dense area, areas of lower density? And then the other question has to do with, is there evidence of people moving to, wealthier people moving to rural areas and buying up, property or large amounts of property, something like that? I mean, I guess what I'm seeing anecdotally is what I'm saying is I'm seeing a shift in wealth and wealth creation maybe to rural areas. Is there any evidence of that?
Not a lot, Elizabeth. I mean, not a lot in terms of a massive amount of this happening. One, we see these trends of companies deciding to move to more urbanized and suburbanized areas, really in part because they've had to, because of labor force needs. They have to find the labor there. They have to have options. And so from the macro level, no. Now everything's not, everything's unique to the communities that are out there. So you take the Bransons of the world, the Lake of the Ozarks, which are benefiting from, the baby boomers retiring. You take, people who may have lived in a community instead of moving down to Florida, want to stay there after they farmed and want to keep growing their wealth there. That definitely happens. Definitely happens. Is it an overarching big trend? No. I mean, if you look at the growth just in the last couple of years of what places grew, it was Florida, it was Arizona, and we could zoom back 10 years. It was Florida, it was Arizona. So on the one hand, it's certainly what we got to be aware of is that these trends don't make the future, but they have to be trends that you've got to work with the knowledge of knowing that this is what's happening and why is that happening and is there changes. So some of the things that coming out of this might be a positive thing for rural communities is that, one, rural businesses are learning they got to get online because you got to get online. I mean, you got, and then you can sell and do things in different places. Secondly, hey, we can work from home. A lot of us can work from home and be productive. That's a good thing as well. I think what we have to counterbalance that with, though, is how accessible is broadband to these areas. That's an issue that I know Congress is debating now, maybe starting to really put some money into that. So if there's a silver lining to this, it might be that we come out of this crisis with the knowledge that we've got to be more online, we've got to be able to operate from different locations. You know, I think of things like manufacturing where on the one hand, labor force is needed, and you know you need a lot of middle skilled people working in there, and a lot of times you can find those middle skilled people in many places in the country. And rural areas are generally lower cost. That's a good thing, but you still need highly skilled technical expertise, IT, engineering types, and those people now are working at plants, but they're serving maybe 3 or 4 plants in 3 or 4 different states, and so their you know transportation access is critical, and of course that broadband is as well.
Right, thank you.
So Alan, this is Bob Schwartz. I completely agree with your slide, taking a look at the challenges of forecasting how bad this is going to damage the economy, and even in some ways how that's specifically going to occur. The question I might ask would be, how is the state right now going about doing their economic forecasts in terms of tax revenue? And is there anything that we can learn from that in terms of better preparing ourselves to assist small businesses in Missouri?
Well, so what the state is doing is looking at 2 things really. They're looking at layoff numbers, and they're getting them daily. And they're also looking at tax revenue from the Department of Revenue. And so they're looking at that. They're also looking at obviously the healthcare impacts and where that's happening. And they use that information to obviously forecast what the economy is going to, you know, or what the revenues are expected to come in. Now, they know, and you know, and we all know kind of that right now is a quarter that we've lost a lot of sales to our tourism, to our service industries, our retailers, our restaurants. That's not going to come back. We're just not going to have that money. We're going to spend money at restaurants and so forth when the economy heats back up, but we can't recoup that lost stuff. So they're looking at definitely that lower financial picture for the state. And of course, it's a balanced budget state like almost every state. And so we end up finding that we're going to have to cut budgets immediately. And of course, that flows to the university and to our communities as well. So I can tell you they are definitely looking at that and looking at that on a constant basis, and have a lot of people looking at that. You know, you asked about what we can do for small businesses. I think you saw some of that survey response, which I think is very enlightening to me, to say, one, of course, you have things like the PPP, which is super critical and a very immediate need. And I know that there's a lot of resources in the Small Business Development Center and so forth doing a lot of great work on that. So that's obviously number one. But you can see the idea of how do I change my business model to look at the online world? What does that mean for me? One of the things that, you know, if you look at your business model and can I modify some of this stuff to be online? Sometimes it takes some creative thinking. Business owners are creative people, but looking out there for good examples of what might be done, given that we have this tough situation right now. I think that Main Street survey was pretty telling in terms of what we might be able to do. You know, short of that, Bob, there definitely is not a pot of money out there other than what we're getting from the Fed to do some of this stuff. And of course, the state budgets and local city budgets are going to be really hit, unfortunately, in the coming year because we're balanced budget, so we have to cut. You know, I mean, and that's just the unfortunate reality there.
Alan, I had a question. You know, initially when this crisis broke out, everyone described it as this sort of V-shaped phenomenon. They thought it was going to go down hard and come right back up. But, you know, now there's a lot more questions about, you know, when you fall this far, this fast, and for the length, you start to break things. And things like corporate debt and even governmental debt plays a factor. What is the kind of consensus that's emerging, at least for now? I mean, I know it's going to change, but what this recovery is going to look like?
Sure. So a lot of economists are predicting it's going to be a couple of years before we get back to the level of employment that we were at prior to this. So think about it as a 2-year window, you know, if that is in fact what happens. And again, this is setting aside the fall because the fall could really throw a wrench into this. But if we're able to come out of this in a few months, where some vaccine is developed and, or the crisis isn't as bad as we think it could be in the fall. So holding all that constant, what I think most economists are thinking is that we'll have a bump in jobs starting back quickly. So you can think of your restaurant jobs, your retail jobs really bumping back up pretty quickly. So if you think of that V coming down and going back up, well, it's that small bump could happen in the next 6 months. We get those jobs back. Then those rest of those jobs are going to take a while to come back. So you think of jobs like government jobs, for example, that now that we're 6 months into it, there's still less funding. Those jobs aren't going to just rebound. The healthcare situation, especially in rural hospitals and so forth, isn't going to go away. And matter of fact, we're facing still constraints with that. So there's not a fast bump on that. So, I think the consensus is some of those jobs will come back quickly, really around the service industries. But some of the bigger employers like healthcare and government may take longer to come back. And manufacturing is one where it might start back quickly as well. But manufacturing is also impacted not just from obviously the health concerns that we see in meat processing, but now the demand. How comfortable are we as consumers going out and buying things? If we do that pretty quickly, that'll help manufacturers. But if we don't, that could also keep them depressed for a while. Sorry, not good news there, but that's what the economists are saying.
Alan, I was kind of surprised that construction didn't show up a little more in rural areas. I know in the Northeast region, we're seeing a fair amount of construction, but a lot of that it seems to be, private homes and that kind of thing. So is commercial construction only what's figured in there?
No, it's all construction, but it is construction that is from payroll construction firms. So if you think about that, that means you've got to employ people as a construction firm to be counted, and that's why we call it the payroll numbers. So in a lot of rural areas, you will have a lot more self-employed construction workers. So they'll be doing projects that they either do themselves, which is again not everything. That's a smaller number of projects, or they may be contracting with people to help out. So I own a firm and I do remodeling, but if I need electrical work, I contract with somebody else. And so they're not counted as one unit. Obviously they're counted in different parts of the economy. So that's probably a little bit that's going on, but also I would say construction mirrors the growth in jobs. And so where you see job growth, you'll see construction growth as well. And so we see that happening in the cities more with the employment growth, and that's why construction's following along that.
Okay, so 1099s are not considered, because I think a lot of our construction guys do that instead of pay payroll. So that's not
right. Self-employed people are under the radar of monthly numbers. That's right. And that'll also hit the ag business as well. A lot. So when you hear the monthly numbers, a lot of times you'll hear it called the non-farm payroll numbers, and because farms that are smaller in size are not surveyed and not counted in that survey, and so they're excluded from that. And so a lot of farms obviously are self-proprietary operations, and so they won't be counted in that.
And then I have another question. On the small business survey, it said it was kind of fast, so I'm not sure if I caught it, but did I understand that them to say they could survive 4 to 5 months with complete shutdown?
Yeah, let me try to find that again.
Because that seems like a long time for some of them in my area to be able to survive a complete shutdown.
So 3 to 5 months was 34%, but then 26%, 1 out of 4 couldn't survive more than 2 months. So you're adding it up there to 60, and then the less than 1 month. So basically 2 out of 3 could not survive more than 5 months is a quick way to read that.
Okay. That's more what I was thinking, but I didn't see this very well to sink in. So thanks.
Yeah, absolutely. And by the way, there's a lot more slides that's there, and I've got a link to it. And there may be a recorded webinar. I know there was a webinar maybe a week or two ago on it. A lot of interesting information, and again, very current. 5,800 businesses is a lot of businesses, and so if you hadn't had a chance to look at it, it might be interesting to you.
Thank you.
Sure.
So Alan had a question about retail. It's kind of a story of have and have nots, right? I mean, some retailers have been extremely benefited by this, but a lot of the sort of traditional retailers that were already struggling, I imagine, are greatly impacted by this. What is the outlook when it comes to those kind of traditional retailers, your JCPenney's, Macy's, those kind of places? I mean, I imagine this could border on extinction level event for a lot of those kind of retailers. I take it.
No, I think you're right, Chris. I mean, the big companies, the JCPenney's of the world, the Macy's and stuff, were already in hard shape in many places, and so we don't. I don't know what'll happen with that, but obviously from the large scale, that's a concern. The small shops, the small retail shops too. They're they're in the shape of a lot of companies of not maybe having serving their local customers, not really having an online large scale operation. We should definitely be very worried about those companies. The longer this goes on, I don't have a real positive feeling right now that they're going to be the impact's going to be small for them. I think it's going to be pretty large, and the second round of PPP will obviously help some, and hopefully some of that will get out to more of those smaller companies. But
well, that's one of the worries I see is there's always while the news definitely moved on to a lot of online retailing. There's older people, which obviously makes up a larger percent of a lot of our counties, still aren't very comfortable. And as you see like a retreat of in some places that were formerly kind of shopping hubs, almost all these traditional retailers disappear. Some of those people are just going to like to keep driving further and further to get that stuff, which has a whole bunch of problems with it, really.
Well, and one of the interesting, kind of thoughts around the idea of not everyone, but a lot more people getting comfortable buying things online. And we all see it in our daily lives, right? We buy things from Amazon, and that means we don't have to go down to the store to buy some things. In the rural communities and in the farming communities, you've had a generation one that's maybe some of that generation older and not really used to using that technology. But now we got this, baby boomers retiring. We've got a younger generation, more tech savvy, more online savvy group of customers who can order things online. And, as long as they don't need it that very moment, why not order that farm implement from someplace else other than right down the road if I can get a discount on that, right? So having that online world could actually shift more of that sales to places outside your local area. So your retail stores could continue to see with this new world of online shopping, some pain with that. And so, it's just something to think about as we move forward. We can see where the job growth's happening. It's happening in the professional technical side of things, more tech savvy people and communities. And that's a growing trend that will not go away. Knowledge is where we're going to keep having gains. And if we don't gain in that knowledge, skilled labor force, businesses that are getting more and more savvy online, then those places they'll continue to face challenges.
Alan, we have a question from the chat. What is included in the transportation category? that you talked about with?
It's mainly transportation services, so it is anything from taxis to bus services, things like that.
Okay, thank you. And there's a few questions too about the different sources you shared, and just follow up. We can share the sources you talked about, and I know there's some other webinars you mentioned too. So other people.
Yeah, let me just for everyone here on the call there. If you go to this site and look at the COVID-19 thing, you can actually hover over a county and you'll see data for some of these things like restaurants and retail. So you can actually get some information. I will caution you, it is weekly numbers that can change and fluctuate. So I wouldn't put it all into 1 week of here's what the numbers are, but if you wanted to track your county over a coming few weeks, you could look at it every, Thursday or so and just look at that number and see what's happening there. Unfortunately, we just can't download it. They kind of block that, but you can at least look at some of those numbers.
Thank you. All right, we still have about 10 minutes. If anyone has any other questions they want to ask.
Alan, this is Jennifer. I just had kind of a random question. I didn't know if you might have some ideas. When we hear of folks that work multiple jobs, and being obviously let go of, say they work 3 jobs, they've been let go of 2 of those jobs, but they are still employed. So my understanding is unable to file for unemployment insurance. Is that correct?
I don't know, Jennifer. That's
Okay.
a good question. I don't know for sure on that one. I think the Department of Labor probably has some information on that because I'm sure they have that question. They got a good FAQ section there.
Okay.
So yeah.
I guess the question I would have is how will that impact the recovery? Or, I guess that's very individualized, but there are certain pockets of communities where that is, that's a norm. Do you see it, or do you have any concerns about those folks, or, how that area would be able to rebound?
In terms of like the multiple jobs or the unemployment insurance?
Yeah, multiple jobs. I mean, how will folks be able to provide if that's
Yeah. Well, no, it's absolute. Jennifer, is absolutely a concern. I mean, because we know, for example, from data from the USDA that most farm operators have another job, right? So most operators have another job, and that's a large part of their income. Sometimes can be that other job, and so whether it's healthcare or retail or whatever it is, not having access to that other job is going to be is going to really hurt you, in addition to your farm incomes going down, at least it looks like this year. So not having options for another job is obviously a terrible place to be. The unemployment insurance, the federal $600 a week bump, if you are able to qualify for that, is very substantial from what the federal government has done before. So that can be a really helpful lifeline to people. And of course, that will be, I think that runs through the end of June or into July. So, that'll be some hopefully protection for some people. But yeah, no, Jennifer, it's definitely a concern. I mean, there's, the truism about 2 things in rural counties that we know will be different in 10 years is that in agriculture and manufacturing, we're going to be able to produce the same amount of output in 10 years with less people. That's just how productivity goes in terms of these 2 big industries in rural areas. And so to grow jobs in those rural areas, you got to grow output way above what you're doing now. And so that just means more technological advancements, more knowledge, more capital. And that's an ongoing challenge for job growth that we see in some of these areas.
Alan, forgive me, this is too kind of a specific question, but there's something I've been thinking about here. Is obviously online sales continue to be a very important part. We've talked about the importance of local retailers even turning to that. At the same time, there's some real questions about what the post office's long-term viability will be. What is the importance, like if somehow post office services were severely limited, or there was interruptions in carrying, I assume that would have outsized effect on rural areas' abilities, because I think some areas now aren't quite as serviced by some of those private deliverers. Am I wrong in that, or do you know much about that issue? I might be too specific, but I just still see those things as being interlinked a little bit.
Well, yeah, they are, and unfortunately I don't have a really good handle on that. I do know that that world of the last mile delivery, the post office, FedEx, UPS are all in these worlds of how do we deliver things. I just a little anecdote. My mother-in-law got a seed packet we ordered from Amazon to send to her. UPS drove probably 5 miles down a dirt road just to deliver to her as the last farm on that road. That's obviously costly for UPS to do that for a package of seeds that might have cost $1. So it's a challenge of revenue and the Postal Service having those challenges. I can imagine that's still that last mile challenge, whether it's delivering a package or delivering broadband, is always there. It's a costly thing. And so how do you supplement that? Obviously, it's been supplemented from federal transfers of tax dollars for decades and decades. That's how we kind of do it. Do we continue to do that as a society moving forward? Do we do something like that with the broadband last mile challenge? Those are all things that are bigger challenges. And I think personally, and I can't really speak to exactly to your question, but I did read about that broadband topic coming back up for the exact same reason, that it is going to cost us a lot of money to do that. Broadband's a little different because we got to understand which technologies are the options out there. But it definitely is impactful. If you grow in online sales, that's going to lead out to or going to spill out to the transportation industry, whether it's the U.S. Post Service or another one. I don't know which one's going to be going to make it.
Alan, I'm seeing a big demand for local foods from my producers. A lot of them are selling out meat, eggs in particular right now, and I think produce is going to, when it comes on, is going to be the same way. Any of the data reflecting that, I'm trying to send them to the Mo Food Finder to get some online presence as well if they don't have it. But if they're selling out, they may not want online presence yet. So. That's
true. Hey, that's a good problem to have if you're just selling out and you really don't have time for some other things like that. Darla, I can't profess to be the expert in that. I know that Sarah Lowe in our group has done work on food markets. There's been some webinars, I think, in the last week on the Engage for Missouri webinars that might answer that a little bit more. But one, that's just absolutely great that they're able to get their products out and sold, and hopefully, through this crisis, we are, we're learning to cook again at home. We're learning to do some things that maybe we haven't done for a while, and let's hope that trend helps our local farmers and our local food markets with that, once this is over. So,
right. Okay, thanks.
This is Sarah, and I would just add to that, I think it will be interesting to see what happens post-COVID if consumers do embrace more diversity in where they buy their foods. Are people who are able to start shopping from a local farmer? So interesting to follow.
And then Sarah. All right. Well, it's 9:50. Unless there's any last minute questions. I don't see any more in the chat. Okay. Thank you everyone for joining. Alan, that was a wonderful presentation. There were a lot of comments of how timely it was, and I think it was really valuable information. We'll definitely share some of those resources Alan discussed in the Engaging for Missouri webinars, that type of thing. And next month, again, we will have Dwayne and Claire, and they'll be talking about their neighborhood leadership program. That was a suggestion from you guys. You want to hear about the other programs your colleagues are doing. So we're excited to have them. Thank you all for joining.
Thank you.
Thank you all.